Okay, what are credit derivatives? Well, they are synthetic credit-linked financial instruments. In fact, what they are is an asset class in the same way as cash instruments exposed to credit-risky reference names, in the way that a cash instrument would be linked directly to the credit-risky borrower. But credit derivatives are simply the synthetic side of the cash coin. Okay? Originally defined as tools to manage credit risk. So if you were to pick up a textbook in, say, 2000, 2002, say 5-6 years after the market began, then they would refer to these being risk management tools to manage credit risk, blah, blah, blah. But in fact, they're just another means of investing in the same way as the cash market, and they can be unfunded, so you don't put up any cash when you invest, or they can be funded, like a credit-linked note. A credit-linked note is actually... credit-linked note. I mean, the original bonds were credit-linked notes, weren't they? If I lent money to some railway company in the 19th century in the form of a 5 or a 10 or a 20-year bond, that is a credit-linked note, isn't it? They've got to pay me a coupon, and that coupon, the ability to service that coupon is linked to their creditworthiness. So that was a credit-linked note. But of course, you know what bankers are like. They have to have fancy new terms every couple of years, right? So of course, we come up with the credit-linked note. And that is a funded credit derivative. But then, how is it a credit derivative? It's not a derivative. It's an actual cash paper. So the terminology, don't get bogged down in the terminology. People break down credit derivatives between funded, CLNs, credit-linked notes, and unfunded credit default swaps. But really, if you're talking about a derivative instrument, then if one defines the derivative as an instrument whose value is linked to some underlying or reference asset or name, then of course CLN fits in with that, because you might issue a CLN from an SPV, a special purpose vehicle, and the value of the CLN is linked to the underlying assets in the SPV. So I've actually answered my own question, having taken the mick out of it first. So credit derivatives are synthetic asset instruments, and as I say in the last bullet point, they're better viewed as two sides of the same coin with cash. Okay? Now, credit derivatives are quite handy theoretically because they enable us to isolate credit as an asset class in its own right. Now, that's handy if we want to do just that, if we want the pure price of credit. If you take a bond or a loan, you've got... What are the elements involved in the pricing of that? You've got the credit part of it, so a bond issued by the UK government doesn't have any credit associated with it. But then having said just that, that would imply that a CDS written on the UK government would have a zero price. But of course it doesn't. So that's an interesting thing to bear in mind. But let's just take that assumption that there's no credit part with a bond issued by the UK government, whereas a bond issued by British Telecom would. So there's a credit part. Then there's the funding part. When I buy a bond, I have to pay cash for it, so I have to raise those funds. And then there's the interest rate element. A bond that pays a fixed coupon exposes the investor to interest rate risk from an accounting fair value point of view. Accountants, everything is all about opportunity cost foregone in the world of accounting. So, of course, if I invest in a 10-year bond paying me 5% fixed every year and interest rates go up 8%, then, of course, I have lost out. So there's the interest rate element. And then there's the currency element as well, when, of course, if you are buying a bond that is denominated in a currency different to your reporting or home currency, you are taking on some currency exposure as well. So that's the bond and the loan. That may not apply, of course, if I'm in sterling and reporting sterling and I buy sterling. Now, when I asset swap a bond, so I buy a fixed coupon bond, but I buy it as an asset swap package. You know what an asset swap is. We're going to look at them very briefly in a second anyway. They're like proto-credit derivatives, if you like. When I asset swap it, I immunize, theoretically, my interest rate risk. So that takes that, and I can immunize the currency risk as well. So that takes those two out, and I'm left with credit and funding. The credit risk and the funding, I buy the bond as an asset swap package. I've got credit risk and funding. When I get exposure to the credit through a credit default swap, I have just the credit. So, of course, the price of the CDS must therefore be only the price of credit. And that's handy to bear in mind because, of course, it means it implies certain things. It implies certain things for what the value of cash funding is, okay? Now, even though it implies it theoretically, the market being the market, when I observe prices in the market, actually that relationship can be turned round. And it isn't always as clear-cut as you might expect from the theory. But from the theory, the CDS is the price of pure credit. Yes, sir? So the question was, whose funding costs are we talking about? Well, this slide is viewing this from the investor perspective. So I've got a funding cost associated because I have to borrow the money. If I'm a leveraged investor, I borrow the money to buy the bond. Of course, the borrower has a funding cost. That's the cost that they pay when they borrow money. And the investor has a funding cost because they will borrow money to invest. Okay? Unless, of course, you're a traditional long-only fund manager, like, say, a pension fund or something. So they get their clients' money and they invest it in cash. If you're lucky, they may even get you an annuity worth £10 a month when you retire. But it's from the investor point of view that I refer to that. Similarly with a credit derivative, when I buy the CDS, in theory, I am investing in only the price of the credit risk. Okay? So why would I want to use one? One's to manage credit risk. We'll come on to that in a second when I look at CDS. One is to earn income when I invest using a credit default swap as opposed to buying a bond. I will get a premium in return for that. So that's the income. I can diversify my credit risk. I can have exposure to assets that don't necessarily trade. This point here would not otherwise be available. The same reason that asset-backed securities or CLOs are viewed as attractive investments for certain investors because they enable investors to get access to an asset class that doesn't normally trade, like, say, prime mortgages or corporate loans. Similarly with credit default swaps, I can write protection, I invest using CDS and get access to a market, once I get a reference name quoted for me, that doesn't normally trade. So we can do all of these things with CDS, manage risk, transfer risk, have access to exposure to risk, invest in it, and diversify across sectors in the way that we can with cash. But in theory, it's more liquid, it's more instant, so it's more easier to deal in. Right. Asset swaps, pro-trade credit derivatives. Just a reference slide for those who may not be familiar with, one never makes assumptions, the asset swap. Of course, this is a type of credit derivative because the investor now has just the access to the credit because it has immunized the interest rate risk associated with a fixed coupon. It's moved from fixed to floating. So, of course, I then have the credit. But you see my point. The cash investor always had that exposure to start with. So I wouldn't include asset swaps in a list of credit derivatives. The only reason I put them in here is because I've come across textbooks that do. Now, for my sins, therefore, the second edition of my CDS credit derivatives book had that. I thought, well, if you can't beat them, join them. But an asset swap isn't, to me, really a credit derivative. It's just a cash-funded instrument where you have immunized the interest rate risk, in theory. So, of course, like any hedge, you don't get one-for-one movement in a hedging instrument. Did you notice I kept on saying in theory? Have you noticed that, guys? In theory. There is no perfect hedge. Well, there is a perfect hedge. Just sell the bugger, right? That's a perfect hedge. You are, similarly with the asset swap, you don't actually immunize the interest rate. All you do is, in theory, move it away. But you still have it. So you are right. And because hedging is more art than science, it's not an exact science by no means, you're either dynamically adjusting your hedge or you're suffering the mark-to-market loss. Or the gain. Sometimes it may move in your favour. Okay?